we're going to see more money printing, and we're going to see risk assets follow that money printing. And when you have the money supply that expands over 7% on average a year, forget about CPI, it impacts the price of these risk assets. Mike is absolutely right. We've been saying this also for a long time, that Bitcoin is the tip of the risk spear. It typically shows when you start having tips the traders off to unwind this trade. And so what do? They sell ETF and they buy back the futures. And the futures is a much, much, much deeper market than the ETFs. And so you're going to see ETFs sell off. You're going to see cash sell off. If you look at the volumes on Bitcoin, they're low. And so does that mean that we see a lot of active selling? No, it means that this has always been the case, that when you reach a top in markets like Nvidia, for instance, it's not that you have massive selling, it's that the bids dry up.
Welcome to our YouTube channel. Lavish remains bullish on Bitcoin in the long term. His optimism is rooted in the expectation of more money printing. Historically, increased money supply has led to higher prices in risk assets, and Bitcoin, being a prime example, often leads this charge. Who asserts that Bitcoin acts as a leading risk indicator. When there is anxiety around risk assets, Bitcoin typically reflects this first. The recent performance of Nvidia is a case in point. As its prices topped and then turned over, so did Bitcoin's. This correlation underscores Bitcoin's sensitivity to market sentiments and its role as an early indicator of broader market movements. Lavish delves into the specific factors affecting Bitcoin's price. The Bitcoin halving, which reduces miners' rewards, is a significant event. Miners with high energy costs may find it challenging to remain profitable, leading them to sell off their holdings. While this isn't a massive factor, it contributes to selling pressure. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
People are looking for a rate cut. They're looking for good numbers for that rate cut. But the problem is we've seen this over and over and over again. The Fed overstays its welcome. They keep rates too high for too long. And when they do start cutting rates, typically the market drops. This is not anything new. I mean, they cut rates and we enter into a recession, or sometimes they cut rates after we've already hit recession technically. So are we there yet? Not quite. Could we be there soon? Absolutely. Am I a bear? No. Long term, I'm very bullish, especially on Bitcoin. But that all comes back to the reasons behind that, which is we're going to see more money printing, and we're going to see risk assets follow that money printing. And when you have the money supply that expands over 7% on average a year, forget about CPI, it impacts the price of these risk assets. Mike is absolutely right. We've been saying this also for a long time, that Bitcoin is the tip of the risk spear. It typically shows when you start having some nerves around owning risk assets. I mean, look at Nvidia last week. It kind of topped out. What was the price at the end there? About 140. I mean, and now it's turned over. And so is it a surprise that Bitcoin's turning over too? Not to me. And it's just the way it is. Should it be this way long term? No. People will start to learn about it and they will understand it. And when they understand Bitcoin, finally, it does have enough market value, it will get out of this leading risk indicator, as Mike, I think, likes to put it, position. And it will start being a flight to safety. But we have a ways to go for that. That we're not there yet. And so as much as we believe it and we understand it, there's too many people out there who don't understand it, and they're selling. And on top of that, just to kind of look at Bitcoin itself, you have a few forces there, and these are not excuses. This is just reality. You've got the halving, which lowers the rewards for miners. And if you're a miner that has high energy cost, and you've been trying to just stumble your way through this, hoping that we get higher prices in Bitcoins so you can be profitable, then you're likely selling what you have in your treasury in order to keep up. That's one thing that's going on. Is it massive? No. I've talked to James Check and Check on Chain, and he doesn't see that, but he does see some. He wrote a whole newsletter about it this last weekend. He does see some. I see some. You see old OGs selling some, and that's obvious. You've got Mt. Gox factors. That's been distributed, or part of it's been distributed, and that's billions of dollars that are coming to market. And then on top of it, you've got this pairs trade, the neutral, the cash and carry trade that hedge funds are doing I think in size. And you're short the perpetual futures, you're long the ETF, and as the perpetual futures, that payout gets to be lower and lower, which Dave can give us the numbers here in a second. That just tips the traders off to unwind this trade. And so what do? They sell ETF and they buy back the futures. And the futures is a much, much, much deeper market than the ETFs. And so you're going to see ETFs sell off. You're going to see cash sell off. That's just so. These
also be selling spot, correct? It's not just
spot. That's right. I'm sorry, spot. That's what I mean.
But it could be both. I mean, both would work in theory. But
yeah. No, thank you. That's exactly what I mean. And so, it's a confluence of factors. Are they excuses? No, it's just a little bit of reality. Do I see us testing these mental levels of the May lows? Or you brought up that chart, Scott, if you can bring that back up again of Bitcoin. It's funny because when you brought that up, I thought that you were sharing my screen because that looks I've got exactly the same channel
that I'm
looking
the range.
at.
I mean,
it's been in this tight range this has been for months now. That's been in this range. This is a long time for it to coil here. Does that mean that we're going to spring to the upside? No, it could mean that we spring to the downside first, it's a possibility. We've been discussing this. It could test that 200-day low, which your arrow is pretty close to. So it could test that moving average right there. Would it surprise me? Not in the least. It looks like it wants to test that $60,000 mental level. That's good. I think it produces long-term opportunity personally. But that's me. And so I'm not too concerned about it. We're in the summer doldrums. It used to be it's sell in May and go away. And, we've hit June here. You're going to see a lot of people in Europe take vacation like they have to in July and August. The markets are going to slow down right as we grind into an election. And so you've got uncertainty with low volumes. So if you look at the volumes on Bitcoin, they're low. And so does that mean that we see a lot of active selling? No, it means that this has always been the case, that when you reach a top in markets like Nvidia, for instance, it's not that you have massive selling, it's that the bids dry up. And so so bids kind of dry up until you see a level where people just can't stand it anymore. They feel like they're finally getting Bitcoin and Nvidia or whatever else on sale, and they step into the market. So that's kind of all the things I'm seeing. I don't see any one major factor, but kind of a confluence of them.
Lavish expands the discussion to broader economic indicators. He emphasizes the unsustainable fiscal situation, with growing deficits and debt levels relative to GDP. The government's inability to allow a natural market downturn due to high debt levels necessitates negative real interest rates. This means that interest rates must be lower than the inflation rate to keep the economy afloat. Lavish expresses skepticism about holding long-term treasuries, predicting persistent high inflation and low real returns. He underscores that managing such a fiscal environment will require perpetual manipulation of interest rates and monetary policy.
Your deficit blows out, like your spending can blow out by 30%, and then your tax receipts can collapse by 20%, 20 or 30%. Typically, your baseline would probably be somewhere around 10 to 12% on each side. So, but if we have a great financial crisis like downturn, the deficit could double overnight. So, but Look, I mean, you got to step all the way back to first principles, and what are we looking at on the first principles, which is to Dave's point, and when you have this kind of debt to GDP, you don't have the you don't have the luxury of just living through and allowing for a natural downturn after massive manipulation. There's nothing's natural anymore. It's all manipulated. But you don't have the luxury of allowing markets to find their way through that. You absolutely must have negative real rates, which is going to your point, Scott. And that is the question of 2%, 3%, 5%, like where are the rates going to be? All we know is that the rates have to come down below inflation long term, perpetually. They absolutely must. There's just no way out of this otherwise. You must have negative real rates on bonds, and that's just reality. And so would I be holding 30-year treasuries in my portfolio? No, I don't hold them. And that's the reason, is I think we're going to have long-term perpetual high inflation and low return on a nominal, on a real basis on bonds. And that's just because you have to have that when you have $2 trillion deficits in peacetime, $35 trillion of debt on $25 trillion of GDP. You are in a spot where you can't get out of. And like Lynn Alden likes to say, nothing stops this train. Like nothing is going to stop this. I too expect that the PC numbers are going to be kind of favorable in that inflation is coming down. But we're seeing a lot of indicators that we're having a rollover in the economy, and so we've talked about this for months now about how long can that fiscal spending prop up enough of the economy that it looks like we're not in recession. Well, at some point here, pretty soon, we're going to bump up through that 4% unemployment rate, and we're going to see that on average, people are struggling out there. So this is not rocket science. We all have friends, and we talk to people who are either young, not able to find jobs, or in the tech industry have already been laid off. So it's just a question of when do we hit that? And we've been, we talk about the Fed a lot. Unfortunately, they do have the Fed has quite an impact to the market, and really Fed expectations. Risk happens fast, so you have to be aware and make sure that you're positioned properly. I think the biggest thing the most important thing, and Dave hit on this earlier, is don't be levered into this moment, because there's no volatility. This is not when you want to be levered. Because when volatility picks up, it picks up very rapidly.
Lavish anticipates that economic indicators, such as the Personal Consumption Expenditures PCE Index, will show favorable inflation trends. However, he also expects a rollover in the economy, as fiscal spending can only prop up the economy for so long. The impending rise in unemployment and other economic stresses will eventually surface. He advises caution in the current market environment, stressing the importance of not being overly leveraged. With expected volatility, it's crucial to be well positioned to navigate the rapid changes that can occur. Please like and subscribe my channel.